What's going on, guys? In this video, I'm going to share with you how to invest in startup companies for as little as $50. In today's video, I'm going to walk you through what angel investing is, how to get started making these early stage investments, the pros and cons of investing in startup companies, and please make it to the end of the video because I'm going to share with you some important considerations that you need to look at before you invest in any early stage company. If you're new to the channel, welcome. My name is Faris Sabeti. I'm the co-founder and CEO of MySwimPro, and in the last 5 years or so, we've built MySwimPro to be a global technology and media company with a distributed team that spans over 10 different time zones. The application MySwimPro has been named by Apple as the best app of the year, been downloaded over 1 million times. The company's doing over 7 figures in revenue, and we've done all of this by raising just under $1 million in external capital. We've raised through venture capital, angel investing, and equity crowdfunding. If you haven't already checked out the video I did how we raised over $500,000 online through equity crowdfunding on Wefunder, check it out, linked in the description below. On this channel, I talk about startups, investing, and entrepreneurship, helping entrepreneurs take their business to the next level. And if you have an idea for starting a company and you're not really sure what to do next, you've come to the right place because I share the right tips and tricks to take your business to the next level. If that sounds interesting, make sure you're subscribed to the channel, like this video. Now let's get right in. Can you imagine being one of the first investors in Google or Microsoft or Facebook or Amazon? Holy smokes, your investment would return crazy amounts. In fact, if you were one of the first investors in Amazon, they raised a $1 million round with about 20 angel investors. Each angel investor put in $50,000. Now I know that's a lot of money for most people, but that $50,000 represented about 1% of the company at the time, and with no dilution, that company's investment value would be worth $3.5 billion in today's terms. That would be a 70,000 times return. Absolutely insane. So we know, why would you invest in a startup company? Obviously, there's a maximize of profit potential. There's a few other reasons why you might want to consider investing in a startup. So number one, in my opinion, is to support the entrepreneur and the mission of the company. You get to get in on the ground level. You're one of the first investors. And by being one of the first investors, you truly are supporting the entrepreneur take their idea to life. And you don't really get that when you trade a public company. Where the company has already achieved their mission and now they're trying to make more money, help more people. But you, as an early stage investor, you can truly fundamentally help the mission of the company. You can invest alongside sophisticated investors. When you're one of the first investors in the company, you get the best terms, you have the maximum upside potential, highest profit potential, but you also can invest alongside the big guns like the Jason Calacanis, like the angel investors. The first investor of Facebook, Peter Thiel, the founder of PayPal, he put in $500,000 for a 10% stake of the company. He supported the mission of scaling Facebook, whether or not you like Facebook, or it doesn't really matter. But this company is now worth over $500 billion when he invested at a $5 million valuation. That $500,000 investment is now billions of dollars. So you truly have the understanding and the potential to get in at the ground level. You might ask, who are the angel investors? Angel investors are people like yourself, me, and you're the people who are investing their own money into the business that they believe can have massive scale and massive return on investment. You're normally the first money into the company alongside the friends and family. So this is way before the IPO. This is normally the first time the company is trying to get off the ground. It's in the garage, it's in the attic, it's in the co-working space. There's no office yet. Maybe there's a few employees, maybe there's 50 employees, haven't really raised outside money, and we're looking as the entrepreneur, as the investor, to support this entrepreneur in taking their business to the next level. How do you make a return in investment, and how does this work exactly? So there's really only 4 ways that this can happen. Number one is through an IPO. So that initial investment, like in the case of Facebook in 2012, the company's initial public offering basically gave liquidity to all of the early stage investors, all the way from the private equity rounds where they raised billions of dollars back to Peter Thiel's initial investment in 2004. Now that one is probably the most rare way to make a return because most companies will never actually make it to a public offering. The second way is more common, and that is through acquisition. So the company is actually bought out and all the shares convert into either cash or stock within the acquiring company. This is much more common. A big example here is MyFitnessPal in 2013 or 2015 was acquired by Under Armour for $475 million. Instagram was acquired by Facebook for $1 billion. We see these in the headlines all the time, and this is the most common way that early stage investors get liquidity and return on investment. The third way is similarly through private equity. Here's an example of a company, Wefunder, in 2019. This ad tech company was bought by Blackstone. This is the biggest private equity firm for $750 million. That's a pretty recent acquisition. This is common and becoming more common because these PE firms can invest or completely acquire these private companies and give liquidity to those early investors. Number 4 is through dividends. This is the more common thing that you'd see in public market, where you have dividend stocks. These are maybe they're more value stocks and they pay a dividend every single quarter or at some frequency, some kind of a return. This is very uncommon in the startup world. So if you're investing, getting a dividend, you're not really investing for the right reasons. That doesn't really make any sense. You're more likely thinking this company is going to become really, really big, go public, get acquired, or invested or bought out by some kind of a private equity firm. And I have 4A, it's not really related to 4. It could be a secondary market. So this is sort of developing right now behind the scenes, but in the next 5 or 10 years, could be this marketplace where you can basically sell your private shares and have a transfer of money in a way that the public market does right now, but in a secondary market. If you're wondering how this is even legal for a company to publicly solicit funds and is this even allowed, there's this thing called the SEC, the Security and Exchange Commission, and back in 2012 there was something called the Jobs Act, and this basically allows private companies to seek public investment from the general public. And back in 2016, this allowed non-accredited investors, meaning normal people like you and I, to invest as little as $50 through Regulation CF, Regulation Crowdfunding. So similar to crowdfunding, this is equity crowdfunding. Again, if you're interested in how my swim pro raised over $500,000 through equity crowdfunding, check it out, linked in the description below. I've also made a few investments through these different online platforms. These are my first 3 investments. All 3 of them maxed out at $1 million plus. I invested in every day. They had 1,600 investors in that round. Turnio Block Card, cryptocurrency, tech company, 3,500 investors in that round. And I most recently invested in Rentberry, a blockchain home rental company, and they have 1,200 investors in that round. So I invested alongside literally thousands of investors. These, I believe the lowest was a $100 investment, and these were put online and these sold out. These were my first 3 investments, and they happen to max out the total allowable. A few different platforms that you can actually invest through. There's AngelList, SeedInvest, Wefunder, Republic, StartEngine. There's a number out there. I'll link them all in the description below. And they allow for an easy way to make your first angel investment. Let's talk about the pros of angel investing. When you invest in startups, I outlined 5. There's obviously the profit potential. This is something that is absolutely absurd if you can hit a good company that's going to scale up and have some kind of an IPO or exit potential. It is unmatchable, the kind of return you can get if you are the first investor. The company is valued at $10 million. In 15 years, the company is valued $100 billion. Now that's really, really low likelihood of that happening, and that's why diversity of your portfolio diversification is really, really important, which is pro number 2, is it allows you to invest smaller amounts in a lot of different companies. And you have access to a diversity of companies, I'll skip to number 4, that allows you to invest in pretty much anything. You can invest in a brewery, a tech startup, any kind of an industry. You have the opportunity to do that. Pro number 3 is that you really do have the fundamental opportunity to support entrepreneurs. You can invest in the founder. You can even speak with them sometimes on a first name basis. Connect with them on LinkedIn. It's amazing to have this kind of connection to a company to invest at that ground level. Last time I checked, you're not talking to the CEO of a publicly traded company. You don't have access to the same level of information that you do at the early stages. And number 5 is obviously that acquisition potential and the future hope of this secondary market where you can have liquidity in a much more interesting way than you do right now, which is pretty limited. This takes us to the cons of investing in startups, and this is really, really important. There is high risk. I talk about the likelihood of a company going from a 10 million valuation to a $100 billion valuation. It is extremely low. A majority of companies, I'll link the data in the description, I think it's something like 16% of companies that take on any kind of venture financing will see one of these options map out, which means 1 in 6 companies have the potential. So if you only invest in one company and you're not diversified, your chance goes even lower of hitting a winner, which is why it's really important to diversify. So it's very high risk. And it's also a binary outcome. This is the thing that really sucks about angel investing. Most of the time, you're not going to see a strong return. You're either going to see no return or a massive return. And I know there's a lot of examples of companies that have seen 2x multiple, 3x, 4x, 5x, 7x return on investment, and that's fantastic. Most of the time, the founder and the team does really, really well. The investor should be happy that they're 5xing their money in whatever period of time. But most of the time, your money's going to go to 0, or you'll be lucky to get your money back in the first place, or you're going to have a 10x or greater return. And that's why, again, it's so important to diversify. And the third con is this lack of liquidity. Unlike a public investment, when you invest in the stock market using one of these apps like Robinhood or even like Wealthfront or Webull or whatever, you can pull your money out. The stock market can be collapsing, is extremely volatile, and whether you make a little bit of money or lose a little money or a lot of money, you can always pull your money out. In a startup, when you're investing early stage, you have an open public offering, and then the investment round closes. You have no way of getting your money back. So there is a lack of liquidity even without the secondary market. There's just no way of getting your money back. So you're investing for the long haul, anywhere from 5 to 7 to 10 or more years, and that has to be your expectation. Now, what are some considerations before you make any kind of an investment decision? And I'll preface this by saying I am just an entrepreneur on the internet. So please seek professional financial advice. Don't take anything. I'll put the disclaimer in the description. Let's move on. The first consideration is to invest in what you know. Don't invest in a brewery when you don't drink alcohol. Don't invest in a tech startup when you barely know how to use your iPhone, right? Use common sense. Think about what you know and have industry knowledge about, that you're interested in learning more about, that you can actually read through the Form C that's filed with the SEC. Similar to when you invest in a public company, you want to be able to look at their balance sheet, you want to look at their quarterly earnings reports. Similarly, you want to be able to look at the data. And if you don't know anything about the industry or that kind of a company, it's really a bad decision to invest in something that you don't know anything about and you're not interested in learning about. So that's number one. Number two is to do your due diligence. Now, if you watch the videos that I made about why I made these investments in Everyday, Turnio Block Card, and RentBerry, I clearly articulated this due diligence and what you should look at when you're evaluating a startup. And I'll overview them here. You're looking at the problem. Is it well articulated? Does it make any sense what the problem is that the company is solving? Is there a clean solution to that problem? It should fit one-on-one. Problem, solution. What is the market size? How many people have this problem? How many people can this solution be served to? If it's B2B, fantastic. What is the total addressable revenue in this market? Same as B2C. What kind of traction does the company have? Does it look like they're on a path to growth, or does it look like they haven't done anything yet? What is the team and who are the people behind this company to bring this vision to life? And does the traction and the market size and the problem solution, does that all fit together? Is there good team market fit? Is there a good financial track record? Has this company already raised $30 million and now they're looking to raise another $30 million and they're just going to blow right through it? Does the cap table look good? Who are the other investors? So look at the finances and then use your gut feeling. You have to really put it together, and this ties in to what do you know as if you're an entrepreneur, if you're an investor, if you look at public investing and you know something about that. How do you tie this all together, and what does your gut say? If you have red flags, hesitations, that means you probably shouldn't invest. If you feel really, really excited and connected with the mission, the vision, and the passion of the entrepreneur, you should think about making an investment. But again, don't take my advice for it. Make your own decisions when you make these investments. And my third and final tip, which we talked about, is to diversify your portfolio. Remember, when you're investing in an early stage company, you got to think about this as an alternative asset class, which means your portfolio, even the professional angel investors that we talk about, these people are only putting 10% or less of their entire wealth portfolio into these alternative asset class. So, if you think about it, if you have $100,000 that you'd like to invest in a year, only 10% of that max should be allocated to these alternative investments. Again, this is just an example. And because we know that the high risk and the likelihood of success is so low and you need to diversify within that portfolio, that $10,000, that's 10% of $100,000, should really be split up into at least 5 to 10 or more investments. So instead of saying, I have $100,000 to invest this year, and I'm gonna invest 10% of that in startup companies, so great, I'm gonna put $10,000 in one startup. No, don't do that. Terrible idea. So if you feel really passionate about a series of companies, diversify your portfolio, maybe put in $2,000 in a few different companies, put in $1,000, put in $500 in 20 different companies. I don't recommend the spray and pray approach where you just invest in everything that you see. Do your research, do your homework, invest in things that you know, invest in the team and the entrepreneurs that you think can really make stuff happen, because at the earlier stages, there's no quarterly earning reports, there's no market sentiment, there's no headlines. It's all about the entrepreneur, their mission, their vision, the traction that they can prove for it. And as an early stage investor, that is ultimately what you are going to follow. You are following the vision and the mission and the passion of that entrepreneur. So you're betting on the team. When you do due diligence, you're betting on the team. I hope you guys enjoyed this video on how to invest in startup companies. Let me know in the comments if you've made any startup investments, what companies you're looking for, what questions you have. Would love to connect with you guys. Follow me on social media. I'll link my handles in the description and on the screen right here. If you made it this far, thank you so much. Make sure you're subscribed, like that video, and let me know in the comments where you're at with startup investing. Thanks again, keep hustling, and we'll see you next time.